All right, let's get right into it. We are looking at one of the biggest and maybe quietest shifts happening in finance today. A potential $6 trillion hole about to be blown in the side of the U.S. banking system. And you know what? The whole thing was kicked off by a product most people weren't even taking seriously a couple of years ago.
So picture this. It's January 2026. The CEO of Bank of America, Brian Moynihan, is speaking to a private group of investors, and he drops this bombshell. He says $6 trillion could just walk out the door of the U.S. banking system in the next 3 years. Now, this wasn't some wild, off-the-cuff remark. No, this was his baseline prediction.
I mean, just let that number sink in for a second. $6 trillion. To give you some perspective on that, we're talking about 30% of all commercial bank deposits in the entire United States. Just gone. Not moving to a rival bank, but vanishing into something completely different.
So you have to ask, right, what on earth could cause a shift of capital that massive? And why is it all happening right now with this sudden urgency? Well, the answer starts with one single event, a catalyst that really changed the entire game.
And that catalyst has a name: BlackRock. The world's biggest asset manager didn't just dip their toe into crypto. They came in and basically gave it the seal of approval for the entire financial establishment. And in doing so, they set off a chain reaction that honestly, I'm not even sure they saw coming.
This timeline really tells the whole story. For a decade, you had pioneers like the Winklevoss twins beating down the SEC's door trying to get a Bitcoin ETF approved, and every single time, the answer was a hard no. Rejected. 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 But then, in June of 2023, the 800-pound gorilla walked into the room: BlackRock. When he managed $10 trillion, regulators tend to take your call. And just like that, by January 2024, the floodgates were blown wide open. And the result? It was absolutely explosive. BlackRock's ETF, called IBIT, didn't just do well, it smashed every record in ETF history. This wasn't a slow trickle. This was an immediate, overwhelming sign that there was a massive wave of pent-up demand just waiting for a green light.
And just look at this growth. It's practically a vertical line. $1 billion in assets in its first week, $55 billion by the end of its first year, and by early 2026 it hit an unbelievable $70 billion. To be clear, some of the most famous funds in the world took decades to get that big. IBIT did it in the blink of an eye. The speed is it's mind-boggling.
So who exactly is pouring all this money in? Now, this is the part that really changes the game. This isn't just retail speculators gambling on their phones. No. As you can see, we're talking about over 700 institutional investors. These are state pension funds, the money that pays for teachers and firefighters' retirements. This is the so-called smart money, making careful, long-term decisions.
So why would these super conservative funds suddenly jump into Bitcoin? Well, it's because their old playbook is broken. For generations, the golden rule of investing was the 60-40 portfolio. 60% stocks for growth, 40% bonds for safety. But after more than a decade of rock-bottom interest rates, that 40% in bonds became dead weight. It just wasn't doing its job. These huge funds were desperately searching for something new, and BlackRock just served it up to them on a silver, SEC-approved platter.
Okay, so the Bitcoin ETF proved that the big money was ready to play. But here's the twist, and this is where it gets really interesting. The ETF itself isn't the direct threat to the banks. It was just the proof of concept. It was the Trojan horse that unlocked the door for the real disruption. And that brings us to stablecoins.
Now, to get why this is such a big deal, we got to do a super quick Banking 101. The whole system is built on something called fractional reserve. You deposit $1,000, the bank keeps maybe 100 and loans out the other 900. The entire model, the entire banking industry, is built on one simple assumption, that we won't all ask for our money back at the same time. And that little assumption? That's the Achilles heel.
Okay, now look at this side-by-side comparison. It's almost not a fair fight. On the left, you've got your standard bank deposit, earning you, basically nothing. Then on the right, you have a regulated, yield-bearing stablecoin. Think of it as a digital dollar, but instead of being stuck in a bank, it can earn you 40 or 50 times the interest. It settles instantly, 24/7, anywhere in the world. You don't need a PhD in finance to see which one is the better product.
And it is so crucial to understand this. This is not 2008 all over again. Back then, the crisis was about solvency. The banks owned a bunch of assets, those subprime mortgages, that turned out to be worthless. This new threat is about liquidity. The bank's assets are fine, but if everyone starts pulling their money out to get a better deal elsewhere, the banks can't sell their long-term loans fast enough to give everyone their cash. The trigger isn't panic, it's just a simple, rational choice for a much better deal.
And you have to realize, none of this is happening by accident. This isn't some organic market shift. Companies like BlackRock aren't just reacting to this. They are the architects of it. This is a deliberate, multi-year strategy to build the next generation of finance and put themselves right at the center.
You not even have to take my word for it. BlackRock CEO Larry Fink has been shouting this from the rooftops for years. He isn't just focused on Bitcoin. That's just the appetizer. The main course, the real endgame, is what he calls tokenization, taking real-world things like stocks, bonds, even real estate, and turning them into digital tokens that can live on a blockchain.
So here's the playbook, laid out plain and simple. Step 1, the Bitcoin ETF. Prove the demand is there. Check. $70 billion says it is. Step 2, build the plumbing. That's where things like their BUIDL fund come in. It's basically a money market fund where the shares are digital tokens. It's the bridge. And then, step 3, the final move. Launch their own regulated stablecoin. That becomes the superhighway for those trillions of dollars to flow from the old system into the new one that they built.
Okay, so we've been talking high-level Wall Street strategy, trillions of dollars. It's all fascinating, but let's bring it back down to earth. What does this massive tectonic shift actually mean for you, for your money, and maybe even for your career?
Well, for savers, the message is pretty clear. The cash sitting in your bank account is like an ice cube on a hot day. It's just melting away thanks to inflation. Stablecoins are going to be a powerful alternative. And for investors, think of this as a new gold rush. And in a gold rush, the surest bet is often on the people selling the picks and shovels. The companies building the infrastructure, the BlackRocks, the Coinbases, the Fidelities, they are positioned to do incredibly well.
Now, if you work in finance, this is a huge heads up. Some traditional jobs might fade, but a whole new world of opportunity is opening up in things like digital asset custody, compliance, and tokenization. And if you run a business, using stablecoins in your corporate treasury could mean millions in extra yield and making global payments instantly. It's a massive competitive advantage just sitting there.
So how can you actually prepare for this? Well, it's not about betting the farm. It's about taking small, smart steps. First, maybe you consider a small 1 to 5% allocation to a Bitcoin ETF, just for diversification. Second, when these stablecoin products show up in your regular brokerage account, move a tiny amount over just to see how it works. And third, and this is the most important part, stay informed. Read the primary sources. Understand the technology, not just the hype you see on social media.
Look, this isn't just another market cycle. What we're witnessing is a fundamental rewiring of the financial plumbing, probably the biggest shift since the internet came along in the 90s. BlackRock's ETF wasn't the main event. It was just the starting gun. That $6 trillion migration is now officially underway. So the only real question left is, are you prepared for what comes next?